Hello, I'm Isla de Haldevang, Client Administration Manager here in Haddington, and I'm joined today by Guido Bicocchi to discuss interest rates and beating inflation.
Thanks, Isla. During the last 2 years, we've seen prices rise at their fastest rate since the early 1990s, and they've remained stubbornly high. Central banks have responded with rapid interest rate rises. Here in the UK, for example, we've seen interest rates go from around 0% to 5.25%. And for the first time in decades, cash is offering an attractive return. But the uncertainty caused by all of these changes has unsettled households, companies and investors alike. While the immediate outlook remains difficult, inflationary pressures and the likelihood of further sharp interest rate rises does appear to be easing. And many clients and investors are asking us what that means for their portfolios going forward.
So with these bank interest rate rises over the last year, people are now able to earn between 4 and 5% on their cash balances. Why are we still investing in company shares?
So cash is seen as a safe investment because deposits are backed by governments and banks. In the current environment, being able to earn around 4% on those deposits is very attractive, and cash forms an important part of our portfolios. But let's be realistic. The security that's provided by those banks and governments to the cash deposits means that investors should not expect to earn the same level of return as they could in alternatives such as company shares. While capital is definitely at risk when you invest in company shares, the prospects are for greater returns.
And can you quantify that risk at all?
Yes, so for example, Western equity markets have returned on average more than 8 times that of cash each year since 1995. But interestingly, cash has actually beaten company shares in 8 years out of the last 100. One such example was in the early 1990s when central banks raised interest rates for the first time, a situation not dissimilar to our own. The operating environment for companies is undoubtedly difficult. The higher interest rates and rising costs have squeezed margins, and we've seen share prices fall as a result. And we wouldn't be surprised if the difficult conditions carried on, suppressing the returns from shares in the short term.
So why do we still invest in company shares?
In our experience, these periods rarely endure, and company shares normally rebound quite quickly when we do see economic prospects brightening. The conversations we're having with management teams have reassured us that they've got strong market positions and sound finances. They're operating in line with our long-term expectations, and they're well positioned to be able to grow again once conditions improve. We will continue to monitor and adjust the cash in our portfolios alongside the bonds, the gold and the company shares. But we still think that for investors and clients who've always got a long-term investment horizon, the best way to protect their portfolios against inflation is to invest in high-quality companies.
Guido, most clients look to us to protect the purchasing power of their portfolios, but I know this has been particularly hard to achieve recently. Why do you think this is?
You're right in that our investment approach has always been directed towards protecting our clients' and investors' capital against inflation. But that's not always possible to do in short periods, particularly when inflation rises so as sharply as it has recently.
So how do we approach such a difficult environment?
Well, we had anticipated a prolonged period of higher inflation and had taken precautions in client portfolios. So for example, where appropriate, we had added to our holdings in inflation-linked bonds and gold. And of course, we continue to invest in companies which offer the opportunity or are well placed to pass on rising costs. The emphasis on high-quality companies and government bonds helped to protect our portfolios from the worst of the market falls over the last 2 years.
So do you think the worst of the price rises are behind us?
Yes, while the immediate outlook remains difficult, I think the inflationary pressures and the likelihood of more interest rate rises does seem to be dissipating.
And what happens next?
Our investment strategy remains cautious at the moment, and we're prioritising preserving capital. And that's through emphasising diversification of asset classes where appropriate, different geographies and different industries. We've also taken advantage of the higher interest rates and yields to boost the prospective returns of the portfolios over the short to medium term. But our clients have long-term investment horizons, and as you know, we believe that the best opportunities are presented by investing in companies in order to protect against rising inflation. Such companies are not immune from difficult economic conditions, but typically their sound finances and their strong market positions mean they're better placed than their competitors to weather such difficult times and to resume their growth when the environment does improve. And the bonds and the gold that we have in our portfolios can be sold quickly and in order to allow us to add to our equity positions when our confidence does improve.
Thank you, Guido, and thank you for joining us today. If you have any questions regarding our discussion today, your investments in general, or any suggestions of further topics you might like us to cover in these videos, please do get in touch.